Well, Wednesday is the new home for your money with Evans Financial, and we got a new guest today. Well, I guess not totally new. You've been here a couple times.
Yeah.
Micah Tipton. Yeah, it has. Micah Tipton here with us today. And Micah, we're talking about something in the news recently. We kind of had to shift our topic today with the news. It's a credit downgrade for the United States. Now, what does a credit rating downgrade mean for a country?
As a mouthful.
Yeah.
So, essentially how we're able to pay off our debts is one of the biggest things that credit rating companies are looking for. And Moody's, in this instance, is the one that downgraded us. And we were at a AAA rating, which is perfect.
Yeah.
And we got knocked down one tier to the AA1. So we didn't take a big tumble, but we went from perfect to excellent still. So, the big question is, why were we even downgraded? Most people understand where our national debt is right now, over 36 trillion. And their big concern at Moody's is our ability to pay down that debt, especially with the way the government spends money. All of that factors into it, and so they saw a need to downgrade us some. With Congress debating right now whether or not they want to extend the Trump tax cuts from 2017, that plays a big role in it, because if they do that, that could add up to $4 trillion in debt over the next decade. So, and I think for context, it's important to note that Moody's isn't the only credit rating company, and we have been previously downgraded in 2011 and then 2023. So that shows you that this is a long-term issue. It's not like somebody walked in and flipped a switch overnight and we dropped down. So, markets were pretty resilient. Yeah. We saw a little bit of a downtick today, I think because of bond rates mostly, which can be affected by a credit rating like this. And so I think most investors realize this is a long-term issue. It's not something that just happened overnight. And really what we're looking at is the long-term effects for consumers. For you and I and the people out there watching is there's this looming idea of a debt time bomb, and that can create negative sentiment in the market. So that can create some volatility in the stock market. Again, it's a long-term issue that people are worried about. But when it comes to interest rates, if the government's paying more on their debt, that certainly means that can trickle down to us, and we're paying higher interest rates. And if the dollar weakens, then that could mean that our prices are going to be going up a little bit. So it's kind of a long-term thing. People should keep their ear to the ground, and just stay up to date with what's going on with these things. And maybe it'll cause a little bit of positive momentum for the government to see this happen. So
well, that would be nice. And you mentioned keeping your ear to the ground. It is a long-term thing. Would you advise avoiding any quick reactionary moves here? Yeah,
I think knee-jerk reactions in the market are always probably a bad idea, at least for everyday investors, for sure, because emotions can really pay a toll on your portfolio if you're not sticking to a strategy. So yeah, definitely no knee-jerk reactions with this one.
All right, well, good to know. And if folks out here are maybe feeling some stress about this and they want to reach out to someone like Evans Financial, how do they get a hold of you guys?
Yeah, you guys can reach us at info@evansfinancial.com, or you can go to our website, www.evansfinancial.com, and check us out.
Micah, always a pleasure, man.
Yeah. All right, appreciate it.
Let's go to Caroline.